I want you to set up what the market reaction is going to be if we get PGIM persistency and yield, or dare I say we go to a higher 5.6, 5.8, and then the dreaded 6% yield. What happens when we get there?
Well, I think we're a long way to 6%, but at the end of the day, we do think yields are too low. If you look at the move that we've seen, particularly in the front end around the banking crisis of March, there was a really, steep move lower, and that doesn't make a lot of sense to us. And so, when we're looking at the curve, we feel like it's mispriced. We feel like it's already pricing in a recession. And then when you look at risk reward, even if you do get a recession, which is still, probable, of course, will you be rewarded for it? And the question on the table, I think, suggests no.
Let's go pro here. There's a thing, Greg, called credit default swaps. Bramo talks about this all the time. You say there's a real efficacy to follow the CDS market. For mere mortals listening and watching, explain the linkage of their yield world with the CDS world.
Well, it just is a measure of credit risk of the U.S. sovereign, right? And so, what we've seen over the past couple months or so is that that risk is elevated, of course, right? So this debt ceiling debate, let's call it, is creeping into the risk of the market. You're seeing that in the CDS curves, and so what you've seen is investors really pay up for short-dated protection in the event of a default or some type of disruption. What we decided to do, and to be clear, this is very much of a drop in the ocean type of trade, but what we've decided to do is actually not pay up for the couple months or even 1 year, because we do think it's a persistent problem. So, I really worry about a PGIM that this political debate around spending and using the debt ceiling as a prop will be a common occurrence. And with that, we think it's good to have a little protection on it.